Right now, the world thinks it's watching a global oil crisis unfold, and on the surface, it makes perfect sense. Energy markets are unstable. Oil prices are swinging wildly. Governments are scrambling, and at the center of all this chaos is one narrow stretch of water, the Strait of Hormuz. A strategic choke point, a global oil choke point, a fragile artery that carries nearly 20% of the world's crude oil supply through a single sea passage. So the narrative feels obvious. Disruption here equals global economic shock. Simple, linear, predictable. But that's only half the story, because this isn't just about an oil supply disruption. It's about who that disruption actually hurts and who it quietly benefits. Because energy shocks don't hit the world equally. They create asymmetric economic impact, winners and losers. And right now, that imbalance is everything. Here's where the story starts to shift. Most people still think about oil crises the way they worked 20 years ago. Middle East instability leads to rising oil prices, which leads to inflation surge risk, which slows down the US economy. That used to be true, because back then, the United States was heavily dependent on foreign oil. Petroleum consumption relied on imports. Global oil pricing directly controlled domestic stability. But that world doesn't exist anymore. Because of one major shift, the shale revolution. Over the past 2 decades, domestic energy production in the US has exploded. New extraction technologies unlocked massive reserves. And the result? The United States is now the largest oil producer in the world, which changes everything. Because now, when oil price volatility increases, it doesn't just hurt the US economy, it also generates oil revenue. It boosts energy sector profits. It strengthens energy export growth. The same crisis becomes an opportunity. This is what asymmetric shock theory looks like in real time. One side experiences inflation and instability. The other gains economic leverage. Now, zoom out. Where is most of the oil from the Persian Gulf actually going? Not to the United States, it's flowing through maritime trade routes toward Asia, toward China, toward India, toward Japan and South Korea. These economies are deeply tied to energy import risk. They rely on Middle East oil dependence. Their industrial systems run on continuous energy supply. So when a supply-side shock hits, for the US, it's mostly a price problem. For Asia, it becomes a supply problem. And those are not the same thing. Higher prices, slow growth. But supply disruption? That's when factories stop. Production declines, energy rationing begins, supply chain disruption spreads across entire economies. This is where global trade dynamics start to fracture, because energy isn't just fuel, it's the foundation of industrial output. And countries with high energy dependency become structurally vulnerable. Now let's add another layer to this, because oil is only half the story. The other half is liquefied natural gas. LNG markets are just as critical and just as exposed. A huge portion of global LNG supply passes through the same shipping bottleneck in the Strait of Hormuz. Countries like Qatar and the UAE depend on these gas export routes. So if disruption happens, it's not just crude oil markets tightening, it's global LNG supply getting squeezed. And once again, the pattern repeats, because the United States has also become a dominant player in LNG exports. US LNG exports are rising, natural gas trade is expanding, and global buyers start looking for alternative energy routes, which means supply disruption in one region creates market opportunity in another. This is how crisis turns into positioning. This is how scarcity creates revenue from scarcity. And financial markets are already reacting. Energy stocks surge. LNG companies' growth accelerates. Investor reaction shifts toward commodity trading impact. Companies like Venture Global and Cheniere Energy benefit directly from these shifts, because when global supply tightens, exporters gain pricing power. Now here's where things get even more interesting, because this isn't just an energy story, it's a geopolitical story. Energy has always been a geopolitical tool, but now it's becoming something more precise. Economic leverage through energy, because at the same time, this energy market instability is rising. US-China trade negotiations are also intensifying. tariff conflicts, supply chain restructuring, economic decoupling. Then the shock itself becomes a strategic pressure tactic. And this is where China enters the picture. China is the largest oil importer in the world. Its energy consumption scale is massive. Its manufacturing dependency is deeply tied to stable energy flow. Yes, China has prepared strategic reserves, pipeline diversification, alternative suppliers, but those are buffers, not solutions, because long-term supply disruptions still create structural economic risk. Factories slow down, exports weaken, industrial momentum fades, and over time, energy security risk turns into economic pressure. So when you step back and look at the full picture, this doesn't look like a simple oil crisis anymore. It looks like a shift in global power balance, because crises don't just create damage, they create opportunities. They reshape economic positioning, they redefine global inequality impact, they shift who holds leverage and who doesn't. And maybe that's the real story here, because what looks like a global oil crisis might actually be a moment of strategic storytelling, a narrative of chaos on the surface, masking a deeper game underneath, a game of supply control, a game of economic positioning, a game of power through energy, because the Strait of Hormuz isn't just a shipping bottleneck, it's a strategic choke point for global supply routes, a pressure point for international power balance, and maybe, just maybe, a tool. So yes, the oil crisis is real, the energy shock impact is real, the market reaction is real, but it's not all bad, not for everyone. Because in a world driven by supply-demand imbalance and shaped by geopolitical positioning, crisis doesn't spread evenly. It concentrates, it shifts, it redistributes power. For some countries, this is instability. For others, it's leverage. Because when oil supply tightens, prices don't just rise. They redirect wealth, they reward producers, they punish dependents. And that's the part most people miss, because we're taught to see crises as universal pain, global problems, shared consequences. But that's not how the system actually works. This is an asymmetric shock. And asymmetric shocks create asymmetric outcomes. One country faces inflation surge risk. Another sees energy sector profits rise. One economy deals with supply chain disruption, another gains market share in global trade dynamics. One region experiences energy rationing, another expands exports and strengthens economic positioning. Same crisis, completely different realities, and once you start looking at it through that lens, everything changes. Because now, instead of asking, how bad is this global oil crisis, you start asking, who benefits from this disruption? Who gains pricing power? Who gains leverage in trade negotiations? Who strengthens their position in the global power competition? Because in today's world, energy isn't just fuel, it's influence, it's strategy, it's power. And sometimes what looks like chaos on the surface is actually control underneath. So the next time you hear about energy market instability or another oil supply disruption, don't just look at the headlines, look at the positioning. Because crisis for one country can quietly become opportunity for another. And once you truly see that, you don't just understand the crisis, you understand the game. And if you made it this far, it probably means you're thinking differently already. So do us a small favor, subscribe to the channel, hit the like button, and stay connected, because we don't just follow the headlines here, we break down what's really happening underneath them.